Hi, this video is a follow-up video regarding the Backdoor Roth IRA. So in my previous the video, then the scenario is when you made the non-deductible contribution to the traditional IRA, you convert this amount into a Roth IRA immediately. Now we instead of convert this amount to Roth IRA immediately. Say, what if you hold on to this? Say, instead of converting this 5,500 into the Roth IRA immediately, you bought Apple stocks using this 5,500 and made a $1,000 gain by the August 2018. So in August 2018, so you may do two things. You say one situation say you convert the total $12,000 in the traditional IRA to Roth. So you convert all of the money in your traditional IRA to Roth. This is the one situation. The second situation say if you convert only the contribution $11,000 to the Roth and leave the $1,000 gain in the traditional IRA. So I'm going to talk about each situation, how you filled out the 8606 form. So first, I'm going to talk about when you convert the total amount $12,000 in the traditional IRA to Roth. So first, you have to understand $11,000 is after tax contribution, so no tax on this $11,000. $1,000 is a capital gain, is a profit, so it is added to your income and taxed at your marginal income tax rate, not capital gain rate. Also, I have a little note here, so just every time when you convert money to Roth IRA, this is true, always true to you. Say, you should pay tax on this $1,000 using the money outside of your traditional IRA. Do not let your bank or brokerage custodian to withhold tax on this $1,000. You'll be subject to 10% penalty on the tax if you are younger than 59 years old. So, what this is saying? Say, every time when you convert money from your traditional IRA to Roth, your custodian may ask you, say, do you want to withhold the tax? Let's just say when you account at Charles Schwab may ask you, do you want to withhold the tax on this conversion? The answer always no. Do not let them to withhold the tax on it, because when you are younger than 59 and a half, the amount, the tax is considered you take out the account. So it's subject to 10% penalty. So that's something you need to know. Anyway, so this is side note. But we are dealing with this situation, say $11,000 after tax contribution. So $1,000 is the capital gain. So in this situation, how we report on the 8606 form. So on the form, so this you in 2018 you made another 5,500 contribution. That this 5,500 is from 2017 contribution. So they both are after tax contribution. You add them together. So this is your total after tax contribution. Then because we made a Roth conversion, so we get on the here. 9.4 is we did not make a contribution in 2019, between January 2019 and April 2019, so that's why it's 0. Then 6 enter all the value on your traditional IRA. The things we assume your traditional IRA is a new one, right? So there's no balance before. So only balance you had was you made a contribution, to contribution, and now have the gain. But because you convert the entire balance into your Roth, so that's why the line 6 is 0 in this situation. So then 7, enter your distribution from, we didn't take any distribution, so this one should be 0. Then 8, enter the net amount you convert from the traditional SEP and the simple IRA into Roth in 2018. So total amount we convert into the Roth is $12,000. So this is $12,000. We also put this amount in line 16 in the second page. So add the line 6, 7, 8, 6, 7, 8. So you get $12,000 here. Then say divide line 5, 9, 5 by 9, 9. So 9, 5 is 11. Divided by 9 is 12. 11,000 divided by 12,000 is equal to 0.917. So then they say multiply 98 by 10, so you get 11,000. Then you add this on line in step 17. So multiply 97 with 10. This is equal to 0, then it's 0. Then add the line 11 and 12 together. So then this is non-taxable portion of your distribution. So this is $11,000 is non-taxable. So we done in this page. Then we go the next page. So this is the number from the previous you added here. So then your taxable amount is the difference. It's the difference. You subtract the 17 from the 16. That's the difference. So yeah, exactly as we said. So you total 12,000 into Roth, $11,000 you no tax, $1,000 you have to pay tax on it. So this is this scenario. How about the second situation? That you convert only the contributions $11,000 to the Roth and leave the $1,000 gain in the traditional IRA. I know in we all think that $11,000 is my after-tax money, so I convert it to Roth, should be no tax on it. Unfortunately, that is not IRS operate. IRS always want to tax your money, so they won't let you do that. The IRS will go by a pro rata rule. This one said, although $11,000 is after-tax contribution, it is subject to pro rata rule when it is converted into Roth IRA because there's a taxable and non-taxable money in the traditional IRA. So the $11,000 go into your Roth IRA have to be proportionate of the taxable and the non-taxable. So the non-taxable amount is 91% of the 11,000. The taxable amount is the 8.3% of the $11,000. So this is you have to pay tax on this amount, and this amount is non-taxable. And how about the $1,000 left in your traditional IRA? So it exactly is like this amount being taxed. So then it's $11,000 left in your traditional IRA is $911. $913 is non-taxable, and the rest of the amount, $87 is taxable. So this 913, this is a base. Base basically is your after-tax money. Basically, they say is basis. It means all the gains. This they will tell you this amount is non-taxable, but the gains will be taxed. So it's a basis in your traditional IRA, and you have to keep tracking it every year. So keep your 8606 form, because it is going to be used to tracking your basis. So if you don't track it, you may pay tax on this amount. So if you don't have the 8606 form to track it. Anyway, so in this situation, then you have to fill the form. How you fill the form in that situation. So this is are the same, and before are the same. So only difference is say, you know what? I have a $12,000 in my traditional IRA. I want to convert $11,000. In your mind, you may think you convert $11,000 is after tax, but it's not. You just convert $11,000 of the $12,000 into your Roth, right? So you left $1,000. So then you have to figure out the taxable amount and the non-taxable amount. So this one, so enter the net amount you convert from the traditional IRA to the Roth IRA. So net amount you convert total is $11,000. So this is going to be go on the line 16. Then you add the 678. You add them together, you get 12,000. So then you say divide 95 by the 12,000. So this give you proportion. You can see that. So basically it says this is your total amount is $12,000. And your after-tax contribution is $11,000. So they give you percentage, right? So then multiply 98. So basically, net amount you convert into the Roth by this portion. If you understand this exactly, they tell you that you have $12,000 in your account, $11,000 is after-tax contribution. So we're gonna tax proportionally on the $11,000 contribution. That's why they do this. Okay. Then multiply 7 is 0 by 9. This is 0 because we didn't do distribution. So now is that add the 9, 11, and 12. You add this together, then you get this. So this is non-taxable portion of your distribution. So yes, exactly as I previously said, that you total you convert $11,000, $10,087 is gonna be non-tax, and you subtract 13 from 3. This is the total basis in your IRA for 2018. So that's why I say you have to keep this form 86 when you have a pre-tax and after-tax, which basically say if you have a taxable and a non-taxable money in your traditional IRA, you basically non-taxable is have a basis. So you have to keep this form to keep track it. So this is your total basis in the traditional IRA for 2018 early year. So this is gonna be next year you have to report it. This is basis. So now to the second page. So this number, it was transferred from previously. So the difference is this, that basically tell you the taxable amount is this.